Welcome to the Property Podcast. Rob D here. No Rob B this week, but don't worry, I found a pretty good replacement. This week, I'm chatting to Akhil Patel, whose work on the property cycle we've been following since all the way back in 2014. And ever since then, Akhil's knowledge of the cycle has allowed him to be very right about what's going to happen next over times when a lot of other people have been very, very wrong. I wanted to catch up with Akhil for a couple of reasons. Firstly, his book, The Secret Wealth Advantage, came out recently, so I wanted to ask him some questions about that. But also, as you'll know if you listened to episode 542 back in August, Rob and I have been having some doubts about the property cycle. And in that episode, we came up with a couple of alternative scenarios about how things might pan out. And I wanted to put those scenarios to the expert and hear what he had to say. And his answers, I think, were very revealing and have certainly given me a lot to think about when it comes to my own views. So I'm sure you will love this episode. And without further ado, here's my conversation with Akhil Patel. Akhil, I hope you're feeling a weight of responsibility because it's down to you to defend the 18-year property cycle on the Property Podcast because Rob and I are losing the faith. We could talk a bit about why. We're falling into this time it's different trap. I know we're doing it, but I still can't fight against it. Are you still on board? Are you still on for a 2026 finish or thereabouts?
A peak in 2026, yes, I am. Maybe I suppose that I should ask you the question, why are you losing the faith?
Yeah, I suppose it's because... So if we sort of consider ourselves to be, 3 years out from a peak, we just feel so far from that behaviour, So we're clearly in sort of like a minor decline at the moment across most parts of the country. I know that sort of other countries are relevant as well, but I'd say probably the same in the US, like sort of flattish as far as I know, not that I follow it closely. And so we've got 2 to 3 years to get from here to mania and then have so much mania, the crash then happens. That feels like a lot to pack into what we've got left from here.
A lot to pack into the next 3 years. I think that's true, but I don't think people were feeling we were that close to a mania in 2003 and the US peaked in late 2006. It's true that 2003 was a big year in terms of growth in the UK and I think in the US. The kind of slowdown and sort of ended around 2002. And sentiment was, I think, fairly difficult in the first part of 2003. I mean, largely because of uncertainty around the Iraq War and where that would lead. And then suddenly it sort of shrugged off in 2004, 2005, 2006, people forgot about it. So sentiment can shift very quickly. I think that's the first point to make. The second point to make is if you just dial out from the last 12 months where, yes, prices have come down by, I think, at least in nominal terms, a relatively modest amount, and we'll come on to that in a second. We are in a situation 3 years after, say, March 2020 or the summer of 2020, where prices on average are about 26% higher. So it's not like it's been a particularly slow 3 years. It has increased fairly significantly. Now, the last 12 months, I suppose that's the issue. So I'm of the view that central banks are always behind the curve. I mean, you've read my stuff for a number of years. I think you know that that's what I think. I think they have basically lost the plot, partly because they don't really know why there's inflation. And part of that is that I think they feel that interest rates should control things and are not paying enough attention to the enormous amount of stimulus that was applied to a relatively buoyant economy. And also in the situation where supply around the world is just not what it used to be 10 years ago for various reasons, both because of issues with China, because of the Ukraine situation, just everyone sort of thinking, well, actually we'd rather have things a bit closer to home. And so you gave people a lot of money, locked them up for 6 months, then made them want to spend. And then you have a situation where the market can't respond. And so prices go up and people still spend. So prices keep going up. I think this is kind of partly what's driving the inflation. I just don't think that interest rates make as much difference in that situation as it should. But it does have a knock-on effect on things like property purchases and so on, because they're obviously very finance intensive. Having said all of that, if you had kind of said interest rates would go from 1% to 5% in 12 months, and you'd have a major sort of European war, and you'd have this and that and the other, and you'd have a potential feeling of a banking crisis, and then you would then think, well, 5% leaving prices still 26% higher than they were 3 years ago. I think the reason why everyone is quite surprised that we aren't in recession and things haven't come down quite so much is because we are where we are in the property cycle. And I think because people don't really understand that, I'm not talking about you, I'm talking about in the kind of the powers that be, they're constantly surprised by why things aren't going down as much as they think they should be. And the final point I'd make is I really don't think they're going to go down much further. I mean, unless yields go up more than they have, which is a possibility, I suppose, because I actually never thought they would get quite to this level. But if they don't, wages have risen since 2020 by about 20%. There's a lot of stimulus going on in the property sector. And I don't mean like, pushing money into it, but measures to get people onto the property ladder and newer products, shared ownership products, and 5% down or 0% down, all this kind of stuff. And rents have increased very substantially, while prices have come down over the last 12 months. Because, there's a lot of demand and there's limited supply for various reasons, frictions in the market. If interest rates are stabilizing or coming down, which I think they're probably starting to come down a bit, and a property can be rented out for substantially more than it could be, next year I think we'll have higher prices. And I think people will start to panic that the market is getting further away from them. And you might get a lot of people in the market at the same time, which then starts to feed in on itself. So that's the gospel according to me if you're losing the faith. Now, look, I could be wrong, and maybe something else will come about, and maybe this is different. But there are things now for you to watch and for your listeners to watch and see if how they play out over the next sort of 6 to 12 months.
Let's pick up on a couple of the potential this time it's different to throw into the mix that say the analysis could be wrong. So one of them is exactly what you've said about the stimulus. So huge stimulus pushed prices up, and now they've maybe got a bit ahead of themselves, got to come back down again. So for me, that would be an argument for an extended cycle, the cycle running long, in that there was this sort of unnatural boom in prices, or boom in everything, but boom in prices. Now that needs to take some time to cool off. So in real terms, sort of coming back down relatively sharply, wages are catching up. You just kind of need to work that through, get prices back to where they would have been if you hadn't had that big spike. And then once that's happened, like, great, okay, now we can kick on with the next phase. So that would imply to me a cycle that ends up running longer than average. What do you make of that?
It's a possibility. If wages can continue to enable people to buy at higher prices and service and so on, if there's enough latent demand, it's definitely a possibility. I think what you will find in that scenario, though, even if it is going up in sort of technically, is that prices of property relative to their rents will get further decoupled. You tend to find there is a decoupling towards the peak of the cycle. I think I put it in my book, or if I didn't, I've put it in some of my newsletters. And you would see that process go on for a bit longer. The thing is, from the point of view of practical investment decisions, do you really want to be buying into that market? And I'm not saying there's a clear answer, but you need to be quite careful. And you might have to go through the discomfort of seeing the market run away from you for a couple of years, potentially. But nonetheless, it's maybe not the sort of market you really want to be putting too much into, or over leveraging or over exposing yourself. So I still think having the framework, even if maybe the timing needs to be flexed, is valuable. Personally, I think if we do get what appears to be a longer cycle, and again, you've read my stuff for a while, and you'll have heard me say this before, I think it will be a bit like the 1920s, where the land price sort of peaked in 1926. Residential prices didn't go up, I don't think, much further than that, although of course we don't have quite the same data as we do now. And it was really the commercial part of the market which kind of went up longer. And so you had all these sort of skyscrapers and other things being built in Manhattan and so on, far in excess of demand and what could be sustained by an economy in normal times. And then once that stopped, that's what really caused a crisis, and the crash and the banking crisis and then the Great Depression. You could see a scenario like that. Everyone works out what commercial real estate does in the post-COVID age, and you get a bit of a glut and there's finance available and it's great investment and so on. And so the residential market doesn't do quite as well as the commercial market. And that's what continues to drive it, because there's a lot of construction. That's good for jobs and that's good for growth. And there's sentiment still positive and people are speculating in the stock market. This is a scenario that is possible and we have historical evidence. I don't think it necessarily means it's this time is different.
Let me throw one more "this time it's different" at you, which would lead to a different conclusion, which is interest rates going from 0 to 5 or whatever it is. It's not only a huge magnitude of change, it's also a reversal of an extremely long-term trend.
Yeah.
So could you say we've had the peak for this cycle? It was in the COVID mania.
Yeah.
And now it's just going to drift back down for however long, though the air will come out of it gradually, because there hasn't been some kind of cataclysmic event like global finance drying up like last time. But everyone's gradually going to come to terms with the fact that prices probably shouldn't be as high as they are now, given financing conditions. So we'll see them drift downwards in a stately fashion.
Possible. To me, I actually think the news is relatively positive. Again, we love negative news in the UK, and the UK has certain specific factors as well. It would be difficult for me to say that we're sort of deflating out of a boom, but a possibility. I mean, it would actually be a slightly benign way to end a cycle. And so I don't think people should be fearful. They should maybe just wait and look for cheaper prices and build up cash positions and so on. And if that scenario is wrong, well, when things start to turn up again, as I think they will, they'll have some firepower to address the market. If that's your view, I don't think it's necessarily a bad one, and just wait and see what happens.
That's where having the historical perspective that you take is really useful, because the scenario I just laid out it makes intuitive sense. But then but for the fact that you go back and look at the history and go, oh, actually, this isn't the most likely outcome. This is probably the least likely outcome in a way. It's quite instructive.
Yeah, it's exactly. I mean, the end of a cycle is violent, and it's violent because, as you pointed out, credit dries up because there is somewhere too much leverage in the system. There's a lot of forced selling. I think no one has a grip on how far the problems can get. And so every so often there's another wave of bad news, another wave of business and banking failure and so on. And it just seems like it's going to go on and on and on. If we are in a sort of the start of a downtrend, I'm not really seeing the signs of that. Maybe they all emerge, but I haven't seen it yet.
If your current view of how things will play out doesn't happen, why will you have been wrong? What unexpected event will have occurred? Or rather, what may you have missed in your analysis?
Well, I think one of the core tenets is that the government and central banks and, the public apparatus are part of the system and forever thinking they can kind of tame the boom and bust cycle and, in practice can't. I suppose that would be something. So what they would have done is they would have responded to a shock like COVID. Again, for me, this is the mid-cycle slowdown. COVID was on top of that, but they've responded to something. They've very much stimulated. They've overdone it. They've realized this problem. They've corrected, and they've managed to avoid getting to the end in the major crisis and collapse. I think that would be a fairly unique scenario. And, that would be probably the main reason why I'm wrong. And maybe we're in a new era of, it's kind of a neo-Keynesian way of approaching public policy, whereby the government is very responsible for the amount of money that's pumped into the economy, can direct bank credit in certain ways, can put money directly into people's pockets. And, this, by the way, I think this is coming. I just don't think it's going to change the cycle. But nonetheless, in the alternative scenario that we're discussing, maybe this is the way forward in terms of responses to downturns in the markets. And, it seems to have amended the boom and bust cycle.
Are you looking to expand your property portfolio or just get started? Well, let me introduce you to Property Hub Invest, the smart and easy way to invest in property. With our vast network and expertise, we provide unique opportunity to access a wide range of high quality, hand-picked properties. So whether you're a seasoned investor or just starting out, our team of experts will guide you every step of the way. Rob and I use Property Hub Invest as well. That's the biggest endorsement we can give it. It's a service that we've built that we love so much that it helps us build our portfolios. why not let it help you too? Check out Property Hub Invest by going to propertyhub.net/invest.
It's a slight change of subject, but we're sort of trying to, from a property investor's perspective, trying to get to grips with whether prices are currently elevated or not. Because I saw two charts that show a completely different picture. So you'll see the house price to earnings ratio, and you'll see that that's clearly like way higher than it has been historically. But then you could also go and look at, sure, you'll have seen the nationwide house price graph in real terms with the sort of the trend line at 2.4% real.
Yeah.
And we're way below, trending downwards, way below the trend, back to sort of 2013 prices in real terms. What do you make of it? How do you reconcile those two? Because you can look at two different things and come to completely different conclusions.
I mean, it's an interesting question. The first point to make, I think, is that there's no absolute level at which houses are, quote unquote, unaffordable. I mean, they are utterly ridiculously expensive, particularly in London. I'm not going to deny that. It's ridiculous. But we've felt this before at lower levels. The peak of the property cycle has occurred at lower levels in terms of median house prices to average wages. And in other countries such as China, the averages are much higher than they are in the UK. So I think that's the first point to make. There's no absolute level. The second thing is the affordability shows that you can get a lot more in terms of debt servicing and so on. So there's plenty of room, I think, for prices to go up and people to pay more, particularly where they're sort of really speculating in kind of real estate and other things. So I think the numbers look crazy. I think there is room for them to grow because there's no absolute ceiling on how unaffordable prices would get. And, you know, I was reading some articles from, I think it was The Guardian in 1998, and they were talking about how first-time buyers are panicking because they can't afford to get on the housing ladder and so on. And of course, prices were much lower. It was a brilliant time to be buying. And, you know, they were unaffordable at that time. It was challenging for first-time buyers and expectations and how much a bank was prepared to lend to them and so on. And the market was more used to maybe people buying on their own as opposed to what people tend to do now, first-time buyers, to buy as a couple or buy with a friend. So those stats by themselves, I don't think, call the end of a particular cycle. They are a feature of it. The numbers always get bigger. The affordability, I think, is important because the whole way that this entire sort of system keeps going around is you have a new supply of first-time buyers to sell your appreciating property to, and it keeps it going.
But you've got bank of mum and dad, you've got longer mortgage terms, exactly. So there's always ways to keep things going for longer.
Yeah, and I understand in the US, you're seeing increasing numbers of sellers helping buyers with financing and other things. Or you pay a lower price and you pay it down over the first couple of years or something to offset the higher mortgage costs. There's, you know, the property market finds a way. Especially
when the alternative is renting, which is also not a happy place to be at the moment. How can we make practical use of the knowledge of the cycle? And this kind of comes into your talking about your book as well, because your book is fantastic. Everyone should go out and buy it. It's one of those books, like, you know, like some people write a book because they want to write a book. Yours is clearly like it's a lifetime of work and study, and it's like it's something that needed to be said and put in a book form that wasn't there. So it really is fantastic. And I think getting clear on the underpinning, like why the cycle exists, the whole notion of a cycle, the whole sort of 18-year duration, all that kind of thing. It is not just a fluke. There are sort of real forces that are underpinning all of this, and understanding that is helpful. But having done that, how can someone make practical use of this knowledge? Well, given the conversation we've just had, at any time, you can just sort of throw objections at it and go, oh, but this time this time that. And you need to sort of really have quite supreme confidence to be sort of unwaveringly making decisions when most of the time, what you're hearing in the media and what people are doing around you is in stark contrast to what you should be doing.
Yeah, it's a good question. And thank you very much for the feedback on the book. I mean, put it this way. People come of age at different points in the cycle, and they get promoted and they get extra income and they get married, so they become a dual income household at different points. You can't time all of these perfectly. You make decisions in the moment. And typically, if you invest and you do so sensibly, then you're not going to go too far wrong, because on the whole, things go up. We're in a society that grows economically and there's technology and innovation and new ideas and other things. So if you're sensible, you're going to be okay. I think what my book helps to do is to say, when you want to be making those decisions, this is what's likely to be happening. And therefore, these are some of the things you could be doing to either enhance your ability to generate returns or to avoid some significant mistakes. I think the second thing, and probably the more important thing it does, is it points out that the moments when it's easy or easier, when sentiment is more in favor, when bank credit and other things is more available, those can quite often be not the best times to be investing. And so therefore, it's not saying don't invest, but be extra careful. And what you must do is not overdo the borrowing or overpay at those moments. It's better just to be patient and wait than to risk ruining yourself financially. Because you can irreparably damage your financial situation if you are having to sell an overpriced asset in a crashing market in order to repay a loan. You'll typically not make your money back, so therefore you have to sell quality assets and so on. You'll have, bad credit record and other things. You may never be able to borrow again, or it takes ages. It takes a very long time to get past that. And some people never do. And I'm not saying this happens to everyone or even to a majority of people, but you don't want to be one of the few for whom that happens. It keeps people on an even keel also, because the news is very emotional, usually pointing in the wrong direction rather. And it gives you a sense of how to interpret what's going on around you. And I think all of those things are important to making an investment decision whenever that might be in the cycle.
Yeah, I agree. I think that the first point you made is a really interesting one I hadn't thought of in quite that way, which is like there are times when you need to or want to act because it's the only time that you can act, but it kind of gives you a way of avoiding mistakes, thinking about what you should be doing. Whereas I think there's a temptation to get frozen in fear as a result of the cycle, as like, oh no, a crash is coming, or whatever, and just end up doing nothing or doing something quite extreme, rather than take the point that you see. It's a way of kind of moderating your activity.
People ask me, should I sell in, say, for example, 25 or 26, and you can, if that makes sense for your circumstances. You want to have less kind of assets, you just want more cash or whatever. But you don't need to. If it's a sound investment, if, say, it's a property and the rents cover your debt servicing costs with a bit of margin, and, you can absorb, say, some arrears or vacancy periods and other things. If it's in a good location, that it's a good property that's not falling to pieces, etc. Why sell? Why not just keep that available for some cash flow and then ride the next recovery? But, if it's in your strategy to get out and be free and just take your cash and sit on a beach in the Bahamas or wherever, this helps with that sort of decision as well.
Yeah, definitely. There is a real distinction to be made between the type of asset. And if you've got quality assets and you're not a forced seller, then that's a very different position from if you've bought something. Like, there's always those properties in really crap areas that fly up in value right at the very end of the cycle, and so you could find yourself holding one of those, and you're never going to get back to where you paid for it for like another 18 years. Whereas I'm sure many of our listeners will have them, like good properties that they ended up they went down in value. Maybe they're on a paper loss for a while, but they've just held them and collected the rent for this long, and it's all good.
I know some subscribers who wrote to me in 2019 talking about their sort of people they knew in their areas. I think it was Sunderland or somewhere in kind of northeast, were saying that people had held on till 2019, that while the property itself was worth less than what they'd paid for in 2006, 2007, with rental income, they'd sort of broken even, and they were prepared to sell now because they'd sort of got all their money out, so to speak. Which, of course, and again, this is maybe where the knowledge of the cycle can help. It's actually not a great time to be selling unless you really want to, because you've done the hard work, you've kept going, and actually probably the next few years are going to be up, and you'll realize some capital growth as well as the yield that you've been enjoying. And so actually, if you could hold on, then hold on and use that sort of surplus cash flow to maybe put your money into something else, But anyway, I think there are lots of different ways in which sort of knowledge of how these things work can help, and it's up to you what you do with it. But I think There's a lot of different sort of facets to it.
You wanted to indulge in a bit of speculation about where this all ends. In my book as well, I kind of got to the position of like, this is unsustainable and it's all going to come crashing down at some point, but unsustainable things can be sustained for quite a long time.
Yes.
Do you have any thoughts on what the trigger might be that means that things can't be propped up any longer and what the world might look like after that point?
It's difficult. It will be something that people aren't looking for. So, people say now, oh yeah, we knew the subprime market was about to blow, and yeah, I'm not really sure that's what they were saying in 2006. It's a risky market, but there were many risky markets and no one really knew how widespread the exposure to it was. And I think the same thing will happen again. It will be some risky market that we're all somehow exposed to, and it's very hard to say where it will be and what will trigger it. But we do know from history there are a couple of things. The first is that it's in an era of right towards a peak, very speculative activity, a very big boom, and money from banks and other places that are financing it being a bit tight because there's so much demand, so much speculative frenzy that banks are able to charge higher rates and people are still going and so on. So it's an era of rising rates in a major boom, and that it will cause some people to be forced to sell things, which then causes the market to pause. Because when markets can get into a situation where not only are prices are going up, but they require an increasing flow of demand to keep those prices going up. In other words, they're paying a price today in anticipation of a gain tomorrow. So it's not reflected on today's fundamentals, it's on what they think tomorrow's fundamentals will be. That kind of Ponzi type market requires an increasing flow of money to go into. And when people even pause, that causes prices to fall. When prices are falling, some people who are overexposed to that are forced to sell, and they're not forced to sell what they wish to, they're forced to sell what they can, which is usually high quality, which then starts to ripple out to other asset classes. And that's how the whole thing starts to spread. And that's how what might seem, as in 2007, a problem 6,000 miles away on the western part of the United States ended up being a major problem all over the place. It will be a similar process, but where it starts and so on, so unhelpfully, it's hard to say right now. It's just in the nature of things that people are not looking out for that. So if it's in the news, it's unlikely to be that.
Yeah. Well, I'm about to say, could it be China? But from the very fact I'm saying, could it be China, probably means it won't be.
Well, the Chinese have had a bit of a bad press for maybe understandable reasons. I tend to think that it's a bit overdone. The Chinese government have been trying to deflate their property industry since at least 2017, in my view. I think part of the problem with Evergrande and Country Garden and so on is they have very high dollar liabilities, and the interest rates being what they are now and so on, it's been very difficult to continue to finance them. And the Chinese government said, well, you sort yourselves out. I mean, probably quietly they're doing stuff, but they're sending that sort of message. And so sentiment is relatively negative. On the other hand, they're really pushing investment in technology, and everyone, I think, ultimately will end up driving a Chinese-made electric vehicle and so on. I mean, they're really capturing some of the industries of tomorrow. And they're relatively closed off still, so probably not China. But it might be Chinese banking interests that are overseas, maybe somewhere along the Belt and Road programs in Central Asia or somewhere in Europe, where Chinese banks have gone overboard and maybe have to withdraw, and that sort of creates the chain reaction which I described earlier. I mean, this is all, as you did ask me to speculate, and this is relatively speculative and quite general, but I think if you read how the anatomy of each sort of crisis, you tend to find the sequence of events take place in that kind of order, just in a different guise in a different location. And that's, in the relevant chapter in my book, I tried to diagnose and dissect exactly how that plays out, but without obviously the details, because we have to go through them in some time in the future.
Yeah, it's really interesting. Is there anything I haven't asked you that you think would be interesting to touch on, or that you'd like to say related to the book, so we can give it a nice hearty plug?
One thing I think you briefly mentioned in your prior question about kind of difficulties at the end of the cycle and so on. Investing in the remainder of this decade is going to be very difficult emotionally. It's going to be against the backdrop of events like we had in this year in Israel, last year in Ukraine, and so on. God knows what we'll see next year, but we're also in a longer term cycle, which I also talk about in the book, the long cycle, otherwise known as the Kondratiev wave, which guarantees lots of turbulence, a lot of conflict, a lot of tension, both geopolitically, so between nations, but also internally, a lot of internal strife. We've seen all of that over the last 7 years, and I think we'll see, if anything, more of that and more intense examples of that over the next 7. So it's going to be emotional. It's not going to be easy. Investing isn't easy anyway, and this is going to make it much harder. But I think that's just how it's, that's just the reality. That's just where we are in those respective cycles. My book tries to help you navigate those emotionally, if anything. See the history, see how these things play out using a different historical episodes, see the sorts of things you should look out for. If you feel particularly negative about the news, and you will during the crisis at the end of the cycle, know that a better day will come, and hopefully my book will help you prepare for that day.
I'm sure it will. Akhil, thank you so much.
Thank you for having me.
What a great conversation. Thank you so much to Akhil. And of course, Hub Extra has to be his book, The Secret Wealth Advantage. Fantastic book. We will link to it in the show notes. That is us done for this week. We'll be back next Thursday with our monthly market update episode. And it has not been a quiet few weeks in the world of property. Loads to talk about, so you won't want to miss that one. Until then, have a great week. We'll see you soon. Bye-bye.